Hello, and welcome to the Three Questions Podcast, where we dive deep into the world of wealth management and connect you with industry experts. I'm your host, Wayne Baxter, Senior Executive Manager at One Capital Management. If you or someone close to you is a high net worth Canadian considering a permanent move to the U.S., especially after a major liquidity event like selling a business, stay tuned. This episode is definitely for you. Our topic, the 3 questions high net worth Canadians should ask about their tax and estate planning strategy when relocating to the U.S. Thank you for taking time to check us out. And if you enjoy this episode of the 3 Questions Podcast, please consider liking this video and subscribing to our podcast and YouTube channels. For high net worth Canadians, relocating to the United States, particularly to South Florida, Texas, or Arizona, is less about politics and more about optimizing after-tax outcomes, lifestyle designs, and capital flexibility, especially around a liquidity event or a major balance sheet transition like an inheritance. Today, we're exploring the 3 questions high net worth Canadians should ask about their tax and estate strategy when relocating to the United States. And joining me on the 3 Questions podcast from Calgary, Alberta is Kim Moody. He is the founder of Moody's Private Client and Moody's Tax. With decades of experience in Canadian and cross-border tax planning, estate and succession planning, and international tax matters, Kim is one of Canada's leading voices for high net worth individuals, business owners, and executive navigating complex relocations to the U.S. Kim, we finally got you on the podcast. Great to see you. Thank you for making time for us today. Appreciate it.
It's a pleasure to be here, Wayne. Thanks very much.
Yeah, we've had quite a few conversations here in Southern California and on Zoom and over the phone and whatnot. And it's great having you on the podcast. And we got a lot to cover today. We're going to cover a really great case planning study. So we'll get right to it. But
yeah,
I think you would agree, even though some things have sort of changed, many Canadians still see U.S. as a desirable location. I'd be interested. I'm always asked. Even yesterday, I was in a meeting yesterday where I was sitting next to a business attorney. I was over in a meeting over in Woodland Hills, California, and he was asking me. He says, "So, tell me, do all the Canadians down here now hate us, or is it just what we're reading in the media?" And I said, "Well, I don't think all Canadians hate Americans. I don't think it's anything like that. I still think there's quite a few that do see the U.S. as a desirable location, but I'd be interested in your point of view and what you're seeing and hearing."
Well, yeah, I mean, there's a lot of media, certainly in Canada. It's thankfully toned down a little bit, but certainly over the last year, it's almost nonstop. America is bad, 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 and even taking American liquor off the shelves. People were cheering that. So silly, very silly. But I can tell you, certainly in my client base, very intellectual, very logical. Business owners, high net worth. A lot of people just don't fall for that, and so certainly in my client base, there has been a tremendous move and shift outside of Canada, with the vast, vast majority being to the United States, and that hasn't stopped regardless of the last year or so. So I don't know if you saw, Wayne, but just on this topic. I often get questions, well, don't the Americans hate us because look how they're treating us, and I don't know if you saw the Buffalo Sabres hockey game the other night where
they chimed in and sang the national anthem when they had the problem. I heard about that. Yeah.
So that was pretty cool. And
yeah.
So in any event, there you go.
Yeah. And I have a guest on my podcast here, Lee Burke, who's a property and casualty insurance broker based out of Boca Raton. Interestingly enough, given our podcast, our case study is about someone wanting to move to Boca Raton, totally coincidental. And Lee's take on it, and he does a lot of work with Canadian and U.S. clients. And he said, if you're a 45-year-old entrepreneur looking to expand your business, you're looking at the U.S. as the option for sure. They're absolutely indifferent to any of the political rhetoric that's going on.
Yeah, so, I agree with that. Unfortunately, there's a lot that that would never move to the United States in any event. They just can't afford to.
100%.
And so it's those ones that tend to fall for the immediate stuff.
Funny you said that, because I know a Canadian, well, he's an expat Canadian now, mortgage broker down in South Florida again, And that was his exact comment. He said, well, a lot of this has to do, some of it has to do anyway with the foreign exchange issues of the we're dealing with currently. That the cost of living in the U.S. is out of reach for some people, so that may affect opinions. But we're beginning to digress here. But before, as you and I always do, it seems to be
Yes,
a
we do.
trend. It's sort of off. We go over here. Okay, before we dive into the questions, I think I'd like to get your take on what surprises people the most when they start digging into the tax and estate implications of making a permanent move to the United States. So you're sitting with a client up in Calgary or talking to them on Zoom, and you get into the weeds. What's kind of the eyebrow opening moment that that seems to happen more often than not?
I think there's certainly in my world, at least, anyhow, and the reason why they come to see me is the tax issues. I mean, um, a lot of Canadians think that the United States taxes in the same way as Canada, and vice versa. And the short answer is, as you know, Wayne, it's just there are some similarities, but the features of the tax system are foundationally different.
Hmm.
And so that is probably one of the biggest surprises is what does their tax life look like once they become a resident of the United States? And it is different. And there's tax and estate planning issues that they now have to take a lot more seriously than you know than they did in Canada. Not to say that they didn't have to in Canada, because they certainly did, but it's different. And so you need to adjust for that. So that's probably the biggest thing
It's just
outside
a
of,
difference in the way the tax structures are, just overall high
yes,
level.
yeah. And what's it going to cost to actually leave Canada? I know we're going to talk
We're
about
going to
that
get to
later,
that,
but
yeah.
so there's that issue. And then the other one is healthcare, which I'm certainly no expert in, but
We've
it's, you
just
got
done some episodes on healthcare. You will be getting getting copies of those episodes. We're actually
nice.
we just did one literally just a week or so ago on the Medicare related issues for non-U.S. residents and citizens. It's Stay tuned for that one.
I'm looking
That
forward to
one's
it
coming.
because we get
Yeah.
questions like that all the time. So
Yeah. So, okay, now we've talked about, the surprises to Canadian, where, and again, you are a cross-border tax expert. So for my
yeah,
friends here in the United States, what is it about the Canadian tax regime that you believe is the most surprising for folks here in the US? And the reason I ask, I got to say right now, because usually around the US federal elections, without fail, I get more than a fair share of inquiries about moving to Canada. And it is not a blue or red. It's either either. It doesn't matter who is appearing to win or going to win the election. I get the inquiry. So just for my American friends here that are, what is it that they need? What would they be surprised about with regards to the Canadian tax system that they may not be aware of?
it's usually the rates that are the highlight feature. Most provinces in Canada, when you combine the provincial income tax rate with the federal rate, it's over 50% at the
North of
high.
50. I got a client in Ontario I was talking to just literally this
Yeah,
week talking about 53%.
yeah. And so that tends to be the highlight, and how quickly you get to that
That
threshold as well.
exactly right. That's the big point.
It's,
You don't really start to feel it here in the U.S. until you get up into the 400 and $500,000 a year income range. But in Canada, it creeps up much quicker.
it does, and it's shocking to most Americans. The other feature, just to finish off on that, Wayne, I often get phone calls from advisors or emails and saying, "Hey, I'm dealing with a Canadian citizen. What are the Canadian tax issues?" Well, Canada doesn't care about citizenship. We care about residency, factual
Residency,
residency, and that is a big difference. In the United States, of course, as you know, Wayne, taxes on residency as
worldwide
well.
income.
But if you're a citizen in the United States, you're taxed on worldwide income. Whereas in Canada, we don't care about citizenship. Those are probably the two biggest features: rates, and we don't tax on citizenship. We tax on residency.
Okay, so we're going to be discussing the three questions high net worth Canadians should ask about their tax and estate strategy when relocating to the United States. So we're going to set the scene here. Let's walk through a hypothetical scenario, Kim, that some of our listeners may relate to. So here we go. We are in the process of selling our business and should net approximately $10 million Canadian and are thinking about making a permanent move from Toronto to our winter home in Boca Raton, Florida. So that's sort of the scenario, selling the business, coming up with a good chunk of dough, and they want to make a permanent move to Florida. So let's get to question number one in this scenario. First things first, is a relocation to the United States a good move? A good move at this stage of our lives? Kim, just one point I want to make before I get to you. How does the timing of a major liquidity event like a business sale influence whether now is the right time to move or not? And I turn it over to you.
Sure. I'll parse that up into 1A and 1B.
Exactly.
And so 1A is it a good time of life? Well, I get that question routinely, like you do too, probably. And I always answer it with, let's take tax out of the equation. Let's not let tax drive the decision.
Let's let the tax tail wag. Don't let the tax tail wag the dog, is the saying.
Exactly. And I use that all the time because I think it's so apropos. If we can make tax somewhat neutral or better, then great. But if tax was not part of the equation, would you want to move? And I can tell you, in many cases, the answer is yes, because clients are wanting they're troubled by weather, they're troubled by lifestyle issues, most recently political issues, which I won't get into, but and so oftentimes those moves are lifestyle driven. And if it turns out that, that it's going to be better for them, then great, we can help them manage the tax issue. So that's 1A. 1B is with respect to timing on a major liquidity event. I'll maybe jump the gun here a little bit because I know we're going to talk about Canada's deemed disposition and departure tax, but it really gets down to what's the value of the business at the time you want to leave. And if it's going to be very similar to whatever the monetization event will be, let's say a $10 million business is for sale, will ultimately be realized on a monetization event. But today the fair market value is 10 million. Well, when you leave Canada and become a non-resident, there's a deemed disposition of that business, usually the shares of a private corporation, at that $10 million valuation. And so that will trigger tax at that point. And so really the trick here, it's not even a trick, is that if you can allow the growth of the business and particularly huge amounts while you're in the United States, that'd be better. So as to minimize the Canadian tax, which will ultimately be higher than if it was monetized when you're in Florida, for example. So for example, let's say the value of the business today is $2 million when you want to move to Boca Raton. Well, you'll pay departure tax on 2 million. Let's say it's 25%, roughly. And then you turn around and you sell it at 10 million. If you do things right, you'll pay tax in Florida on the increase of 8 million, and not the full 10. And that 8 million will be at lower rates. So the trick is to look at, is there a legitimate way to play with the timing so that ultimately you can get better tax rates on an ultimate disposition. But if the fair market value is the same when you leave Canada as to when you monetize, there's really not a lot of games you can play there, Wayne.
So in theory, you can make the argument that if you have a growing business that's operating successfully, and you are, I remember seeing a newsletter from you, and I can't remember, it was a year or two ago. I remember this now about the comment that you made is that the day you should start about selling your business is the day you open it.
Absolutely.
Do you remember that? I don't know if you remember.
Yes.
You wrote an opinion piece on this. I remember reading because Kim's fairly proficient, and I get to see him quite often having commentary in the Canadian financial newspapers and publications, and I remember that. So what you're basically saying, if you have a going concern in Canada that's operating and efficiently operating, and it's not relying specifically on the owner being there, you can make the argument that a relocation sooner than later could potentially make sense from a tax perspective over the long term.
Yes, absolutely. If you can make the legitimate argument that the accretion of value occurred after you left Canada, That's beautiful. That's a great plan. Now, in many cases, it doesn't happen that way, but if you can time it that way, then perfect.
Yeah, I will say that in addition to the tax and estate planning questions, which obviously are important, a family that's looking to relocate to the U.S., and this is something I work on all the time, they need to think about the immigration process.
Yeah.
And I'm telling you, it's not getting any easier. I mean, I got an
Hmm.
email literally this morning of a client that's going through an EB-5 process that they've been working on, I'm not exaggerating, for over 10 years, and they're
Wow.
still not across the finish line. So immigration,
Yeah.
sure, I will say this. I've said this on, we just did a podcast on immigration here not that long ago that it's a for most people, especially entrepreneurs, it's a two-step process. It's relatively, in quotes, easy to get into the United States if you're an entrepreneur. Becoming a permanent resident, that's a whole different story. So we need to understand the immigration process, but beyond that, there's a lot more to think about. There's you talked about earlier. There's healthcare to be considered, the cost of healthcare, the cost of related to home ownership and insurance, and depending on what part of the country you live in, property insurance can become an issue. Uh, and age can be an issue too. I'll say this, especially if maybe you don't have $10 million, maybe you only have a couple $1 million, right? Nothing, no shame in that. But one thing you got to think about on the timing is the older you are, the more riskier it gets because you're probably going to want to qualify for Social Security because it is not a small part of the income, the retirement income picture, even with all the talk about what's going to happen to Social Security in the next 7, 8 years. I don't think there's a Congress person on either side of the floor that's going to want to be, or a senator is going to want to sign off on the dissolution of Social Security. So that's not likely to happen. So there is going to be Social Security. So you want to be here long enough to qualify for those 40 credits that you have to get to qualify. So there's some timing around that. These are things that you need to think about and cash flow
Yeah.
and plan around. So that's my 2 cents on that. So there's a lot to think about, not just the selling of a business. There's other variables. But I think it's really interesting what you said, Kim, was that if you have the ability to sell your business or pardon me, to keep operating your business as a resident in the United States, a Canadian business, that could be a way of mitigating some of the tax implications. So well said. Our topic today is the 3 questions high net worth Canadians should ask about their tax and estate strategy when relocating to the U.S. And joining us again from Calgary, Alberta, is Kim Moody. He is the founder of Moody's Private Client and Moody's Tax. And he has decades of experience in Canadian and cross-border tax planning, estate and succession planning, and international tax matters. And he is one of Canada's leading voices for high net worth individuals, business owners, and executives who are navigating these complex relocations to the U.S. So, Kim, let's move on to question number 2 of this case study. Again, it's a couple who are just in the process of selling their business and they're wanting to make a permanent move from Toronto to their winter home in Boca Raton, Florida. So here we go with their second question. Assuming we do decide to relocate, what are the major tax consequences of leaving Canada? We keep hearing about the exit tax and something called pledging security as a way to defer taxes owing to the Canada Revenue Agency. Uh, I'll just say this. For someone with a $10 million business sale, how does the deemed disposition rule actually work in practice? And what are the most common strategies that you would implement to manage that tax hit? So over to you, Kim.
Yeah, that's great. Great question. And on a day-to-day basis, um, certainly in my practice, for people that are leaving Canada, that is the biggest issue: is how do we deal with the departure tax? And so just to reiterate what the departure tax is, because Canada taxes on a residency system, not on a citizenship-based system, when you cease to become a resident of Canada, which is mainly a factual test, if you no longer
Mhm.
have any ties to Canada, which is the big issue, then you're deemed to have disposed of all of your worldwide assets at fair market value immediately prior to you becoming a non-resident of Canada. So let's say you moved to Boca Raton, like you mentioned in this case study, you moved July 1st. Well, on June 30th, there's a deemed disposition of your worldwide assets at fair market value. There's a bucket of exceptions. There's 5 buckets of exceptions to the rules. I'll just give you a couple of them because these are the most common. Um, the any kind of deferred income plan like RSPs or RIFs are not subject to the deemed disposition
Right.
regime. And the reason for that is simple. Canada will get their pound of flesh when the amounts are withdrawn
Yeah,
as
there's
a
a
withholding
withholding tax
tax.
rate of usually 25% that's taken
That's right.
off.
Yep. And then any Canadian real estate that's owned personally, no departure tax because again, Canada will get their pound of flesh when the real estate is ultimately sold. So, dealing with the business sale, getting to that, the most common thing that happens is that business is owned through a Canadian company typically. And so the
Mm.
shares that are held by the shareholders, mom and dad, for example, are deemed disposed of at fair market value. And in many cases, the cost base of those shares is minimal. And so if we're dealing with a $10 million sale, that will trigger a $10 million gain and using Ontario rates, you're going to pay tax um, at 53.5% of the taxable portion, which is only half of the gain. And
Hmm.
so, in a nutshell, let's just keep numbers simple. It's 25% of the tax. In reality, it's a little bit higher than that, or of the gain. I mean, and so mom and dad are going to have to find a way to pay $2.5 million of tax.
Hmm.
And so I actually had a conversation about the so-called deferral. I don't like calling it a deferral because there's 2 ways you can ultimately pay the tax. One is you got to write a check when you file your tax return, mom and dad, for the 2026 tax year, which is due in 2027, April 30th. And you're going to write a check for $2.5 million. But what if mom and dad don't have that liquidity? Well, that's when Canada will allow what's called adequate security to be provided. And that really is up to the discretion of the CRA to accept whatever the security is provided. And in many cases, historically, it's been very, very conservative kind of stuff that they've allowed to, have security be provided, a letter of credit or a secured line of credit that or a mortgage against a real estate property that they're satisfied with. Those were typically the 3 pillars, uh, and call it 2 letters of credit or lines of credit or mortgage. They've relaxed it a little bit where they will allow the shares of this private company to be pledged as security. But the problem with that, Wayne, is that CRA now becomes your business partner. There's going to be restrictions on dividend payments, and it really does hamper you. So it's not as easy. So one of the things that we deal with a lot with situations like that is look at, are there ways to minimize the departure tax? In some cases, you can't. And what is the best way to pay for it? Can we come up with cash so that we don't have to pledge the shares as security? Because it's a pain. It's a real pain to do that. So it's not a deferral, Wayne. It's using other types of assets other than cash to pay for that tax. As long as CRA is satisfied that they're not going to become your business partner. They don't want to become your business partner. They don't want to accept any investment risk, and that's why typically you'll look for other assets.
Okay.
Failing that, you could be in a lot of trouble if if there's no ability to pay the tax.
Right. So I guess that leads to my next question. One Capital Management, we're portfolio managers. We manage money,
Yeah, yeah,
stocks, bonds, ETFs. And what makes us unique is that we're licensed in both countries. So we manage money for clients that are living, Victoria. I got clients in Victoria, British Columbia, all the way across over to Pictou, Nova Scotia, and pretty much everywhere in between. So one of those folks, they have a low cost based stock and bond portfolio, non-registered. Will this type of pledging security work for those people that have, these large stock portfolios and they have like a low cost basis? Let's just say it's in that $10 million range, or is it just not even on the table? CRA will even look at that.
it really is a question of fact, Wayne, on each case. But using your example, if the CRA is satisfied that the clients have liquidity to pay, then typically they'll want that liquidity. They won't be that interested in entering into alternative security arrangements. Um,
So they
so
have a regular stock and bond. They have your typical Canadian U.S. stock positions with the
yeah,
high. Let's say there's a $10 million portfolio with a $5 million capital gain. I'm just using round numbers
yeah,
here.
yeah,
And the client says, "Well, you know what? Is there a way we can at least mitigate, slow play this paying of my taxes to CRA?" And we go to them and we show them a portfolio of, here we are. We got all the names you recognize in a stock and bond portfolio. Would they consider that the liquidity? Would they be comfortable with that, or would they want another arrangement, or would they just say no, just pay us the tax and make your way to the U.S. and forget about it?
yeah. I hate to dismiss that example, but if the CRA thinks that, yeah, this is just a way to not pay the tax right now, then they probably wouldn't enter into arrangements. But if there is a good reason why, like for example, let's say the stock is not all that liquid, or they can convince the CRA that, hey, they want to hang on to it for whatever reason, as long as it's not investment type things that the CRA is going to share in, then you very well might, because that is the type of security that the CRA likes, right? Is they do like investment portfolios that have longevity to it. And so it really does depend, Wayne.
So
I
that's a
hate to,
classic case where this is a classic case where I could basically bring you into the conversation and you could be a liaison with CRA. Would that be the role
yeah,
that you?
yeah,
Perfect.
yeah.
Perfect.
And we do
Perfect.
that quite routinely. I can tell you right now, though, if it was, let's say there's a whole bunch of like a bunch of cash in the system, but there's gains elsewhere, the CRA may not be interested because they do want to see the whole picture, right? So
100%. Got it. Well, again, this is a great, this is why, you and I work together. These are classic
yeah,
examples.
yeah.
Okay, let's move on to question number 3 of this hypothetical case study of a couple who've sold their business. They've netted $10 million, and they're thinking of making their Boca Raton winter home their permanent residence in the U.S. So let's move on to question number 3. Here we go, Kim Moody. Once we have become U.S. residents and seeing that we already own our own property in Boca Raton, Florida, what does our life look like from an estate and tax planning perspective going forward? Over to you, Kim.
Well, I'll parse that into 1A and 1B again.
Go ahead. That's fine.
So 1A is the income tax side. And this is what we deal with clients is, what does your income tax scenario look like? What are your income sources from that point forward? Is Canada even involved? Or will they be involved? Like, for example, will there be withdrawals from RSPs at some point in the future? And if so, how does that match up against the US tax? So we look at the income sources in a very simplistic scenario, which is not very many scenarios that we deal with. But let's say there's going to be no Canadian source income and therefore no Canadian tax from that point forward. Well, now it's just the United States. And you can just deal with the United States people like you, Wayne, and other U.S. tax people, and that's the most simplest thing. So on the income tax side, just to finish off on that, we do look at what's your ongoing income sources. Where are you going to get your money from? And is Canada involved? And do we need to be careful with that? And in most cases, the answer is yes. On the estate planning side, which is 1B, and you know this just as well as I do, Wayne, the estate planning documents that the client typically had in Canada, a will, power of attorneys, living directives, what have you, those are likely not going to be all that useful anymore
Mm-hmm.
once you're in the United States. The United States does not have uh, the type of death tax system that we have in Canada. In Canada, when you die, very much like becoming a non-resident Canada, you're deemed to have disposed of all of your assets at fair
Exactly. In the
market
year
value.
of your demise.
Right. And there's some
Yeah.
deferrals if those assets
Yeah.
go to surviving spouse, but
Yes.
but the United States doesn't have that regime, as you know. It has an estate
Exactly.
tax regime.
Right.
And so the short story is we need to deal with estate planning attorneys, people like yourself, to make sure that ultimately what's their planning look like now? Do we need powers of attorney? short answer is yes in 100% of the cases. And what else do we need? Should we use trust in the, trust, revocable trusts are usually a tool of choice in the United States
There
for
can be
various
other,
reasons.
the irrevocable trust. I'm actually dealing with a case right
Yeah,
now of a client of mine who's relocating to the United States, and in their ownership is not only your typical, the RIF, non-registered accounts. There's a TF, and we could talk about TFSAs, by the way. Just we table that one, okay?
sure. Yeah.
We'll just make a we'll slip that in there. But they have TFSA money that will have to be moved to the U.S. But also there's a significant position in a privately held business that is expected, anticipated to go public. And to me, I think there's a possibility there where you might even want to look at some kind of asset protection strategy as well, which may require, and again, I'm not an estate planning attorney and I don't play one on TV or anything like that, but I could see the need for some asset protection here, especially if these shares really pop, which is highly, it's possible.
Mhm.
So, I mean, I've had guests on my podcast before who've talked about, utilizing asset protection strategies. We really, you're talking the difference between a revocable family trust and an irrevocable trust, which
Mhm.
they're both trusts, but one is basically very malleable, where the other one, the irrevocable one, just by name means it's not. So depending on how complex it is. So there's that option. I just want to chime in just for the folks that are listening in Canada, the Canadians that have utilized to their benefit the tax-free savings account, or the TFSA as it's commonly known. And the surprise to some folks when they find out that once they become a U.S. resident, that TFSA doesn't behave or isn't looked at the same way as it does when they were merely or only a Canadian resident. Maybe you can just explain the rule there on how TFSAs change once you become a U.S. resident and why they're really not as
Sure.
much.
Yeah. I mean, so let's say you've got $100,000 in your TFSA and you move to the United States. Well, at that point, you cease being able to contribute further because in order to contribute further to a TFSA, you need to be a resident of Canada. And so you got to be careful not to contribute further because that could trigger significant penalty tax. So that's number one. Number two is, as I understand, I'm not a U.S. tax expert, but certainly no dummy when it comes to cross-border stuff. Is that TFSA could be, the earnings in that TFSA could be taxable in the U.S. And at a minimum, there's reporting requirements. And so you want to make sure that you file the necessary reporting requirements in the United States to
It
avoid
it
significant
it it
penalties.
it just makes more sense from everything I've talked to with all the tax experts that I know here in the U.S. that it makes more sense just to bring those assets to the U.S. and again
Completely.
and put it into the revocable family trust if that's the deemed location for it, or individual account or however. And we all know the reason a lot of times Canadians don't want to do that is because of the foreign exchange, right? They don't want to
Yeah.
convert U.S. And again, I will just wave the One Capital flag here rather proudly that one of the great things about One Capital is that we can bring Canadian dollars to the US and not convert them to USD. I've got plenty of clients here that are expat Canadians that have either inherited money from Canada or came here with Canadian dollars that have Canadian dollar denominated accounts. So your TFSA account been a great tool, no taxes on the growth, and it's now time to move to the US. We can bring that money across the border and keep it in Canadian dollars. So that issue has been basically mitigated.
Yeah.
Um, okay, one last thing just on this third question, and we carry
Sure.
on here, not surprisingly. Just how do the US estate tax rules and the US Canada tax treaty change the planning picture for the Canadian couple with significant assets? Just to wrap this up and then we'll move on.
Yeah. I mean, um, in your example, has the client moved already, or they're still
Yes.
in Canada? Okay,
No,
if
no,
they've
they're
already
here. Yeah, yeah, for the case we're talking about. They've decided to move. They're here.
okay, if they're already there, they've more than likely incurred the departure tax, which would be very similar to what they would incur, not
Mhm.
identical in most cases, but very similar to had they died. And so ultimately now, as you know, we need to look at, okay, is there going to be any U.S. estate tax exposure? And with the one big beautiful bill, that estate tax exemption in 2026 is now 15 million being indexed to inflation. And so for clients that have 15 million or as a couple 30 million US, um, they're not going to be exposed to the US estate tax, but it is a political football, as you know.
I
And
was
so
just going
who
to say that's for the time being.
exactly. So you never know, right? But um, and so that is something that we advise clients to, keep a close eye on that down the road and make sure their
100%.
wills are contemplate that. There's some decent plans that can be done to try to mitigate that. Working with people like you and estate planning attorneys in the United States. The planning is even more complicated if all of a sudden they're Canadians with a whole bunch of U.S. assets. But that's not our example today. But
That's
there are
another
some,
episode that
so that's
will.
another episode.
Yeah, we'll get you back. Okay, I got to I got an aside. I'm going to throw this in, kind of off. We've basically done
And
through
I
the
got an
three.
aside too, by the way, once you're
Okay, you
finished.
go
So,
first. You do your side, then I want to get to mine.
okay. So I think you're still a Toronto Maple Leafs fan, right?
Oh, you had to bring that up. Yes, yeah, we did get our first round draft pick. Yeah,
Well,
that
that that's what
yeah,
I'm bringing up. I'm a little bitter about that as a Calgary Flames fan. So
yeah.
that's why I wanted
Well,
to bring that up.
yes, yes. So you know what? I'm at the low ebb of my enthusiasm right now. I think I'm in for a 10-year slog back to glory is what my anticipation is. So
I'm in the same boat, Wayne, when it comes
yeah,
to my
whereas
Flames, but
I'm thinking I'm going to become a San Jose Sharks fan. Uh Follow Macklin Celebrini. Okay, so I want to bring up something again a little bit off the topic, but not really. So a question I have been asked to address more than once, especially over the last few months, is how this is a key part, dual US and Canadian citizens should address the need for permanent life insurance going forward. So, again, not a tax expert, but from what I can tell, the IRS really doesn't like a Canadian permanent life insurance policy that has a cash balance. And Canada Revenue Agency will look to, in some cases, tax the income earned on a U.S. permanent life insurance policy. So for someone who's filing with the IRS, regardless of where they live, whether they live in California, in Florida, in Toronto, Halifax, Vancouver, do you have an opinion? And if you don't, it's okay. But I'm just curious if you have an opinion, which is the better option? If you are a filer you have to file for the IRS and you have to pick between a US and a Canadian permanent life insurance policy, do you think there's a lesser of two evils?
yeah, I think if you're a U.S.
If you're, if you,
resident,
yeah, if, yeah,
then certainly a U.S. policy makes it simpler because the U.S. insurers will make sure that ultimately they comply with the regulations. And
yeah.
but if you want to mix it up and buy a Canadian policy for some reason, I'm not sure exactly why. Maybe it's cheaper, maybe it's more available. Who knows what the reason is? Now all of a sudden you got to deal with what you already said. Does that policy trigger taxable income on the cash value component of any investment income? And I can tell you in practice, Wayne, that's something that we struggle with because we do find cases like that routinely where you have an American that owns a Canadian policy and vice versa. And the rules are not as synchronous as I'm sure
And
you
I'll
know.
tell you right now, I've had this conversation, the US life insurance companies will abdicate completely on how CRA treats their policy. And there was one opinion piece I read from a few years back of a Canadian, I won't say who it is, but a Canadian-based tax advisory firm who said that you shouldn't buy a US life insurance policy unless they guarantee it's going to abide by Canadian tax rules. And there's no life insurance company in the United States that will
No,
ever. That's to me kind of a it was
that
a hot take, but
sounds weak to me.
yeah, I would agree with you on that one. So to me, I mean, if you are, I guess what I'm hearing, and again, I'm open to be proven wrong, it seems to me that the lesser of two evils, if you are reporting to the IRS, that's the key part, regardless of your residency, whether you're United States or Canada, it would seem that a US policy is more favorable than a Canadian one. That's my.
And I would agree with you, Wayne. In practice, when we deal with this issue, we struggle mightily to get opinions from
Yeah,
ultimately the insurance
100%.
companies, right?
And,
So
and trying to get opinion from CRA on any of this stuff or anybody like
yeah,
it's
good luck.
all right.
Good
Okay,
luck.
Kim, you know what? Based on our conversation, and naturally I knew this was go off on a few tangents. Uh, um, what is one actionable step a high net worth Canadian contemplating a move to the US should take right now? What would you say right out of the box?
Well, I think you kind of led to it earlier, Wayne, is figure out the immigration piece first, right? Because that's the biggest issue is how are you going to live there?
Mm-hmm.
And is there a clear path? I can tell you in my experience, the answer is more times than not that there is a clear path, but it takes time and effort, and it's not simple. That I think that would be the biggest actionable.
Yeah,
And then the
I
sub
do
action,
not disagree with you at all on that. I would tend to agree that they are almost the immigration part of it is kind of the first entry point
yeah,
of
how
like
you
not,
getting there?
and then once we have an idea of the timeline, that's where you and I get together and kind of figure out from there where we move.
Yep.
Yeah.
And then of
Okay.
course most Canadians are freaked out by healthcare because they're pumped by media or whoever is saying that healthcare costs are astronomical, and of course in Canada it's public healthcare which comes with its costs and challenges. So that would be up towards the top of the chain as well as to look at that.
Yeah. Okay, so for those who are watching us here, we put all of your contact information right below you. They can read on the screen your phone number, email address, all of that. But we got folks that are listening on Apple, Spotify, they're driving around in their cars or out for walks, whatever. For those folks that are listening in, what is the best way for them to contact you if they want to reach you directly?
Well, a couple of email addresses. My firm address is kmoody, so KMOODY at Moody's, so that's MOODYS, so plural, tax.com. Or my personal one, which is KGCM, which is my initials for Kim GC Moody, at kimgcmoody.com. So, and I'm very responsive on both those. So that would be
I'll
the
agree to
easiest way.
that. You're always quick to get back to me, so that's perfect. Kim, thank you. This has been awesome. I really
Real
enjoyed
pleasure,
having.
Wayne.
Definitely, we're going to do this again, 100% for sure. Thank.
I always like chatting with you.
Okay, you take care. Kim Moody is the founder of Moody's Private Client and Moody's Tax. He joined us from Calgary, Alberta. Soon to have a new hockey arena. One of my very best friends is actually one of the contractors on that, or one of the foremen on that project. So eventually, it's going to have a roof. Eventually, I got some pictures last week. You got the outside of it. You got to put a roof on that because it gets kind of cold there.
A little bit.
Kim, thanks a lot. We'll see you soon. All right, take care.
You bet. Pleasure.
I look forward to bringing you the Three Questions podcast, and I hope you find them educational and informative. Please consider liking this video and subscribing to our podcast and YouTube channels. And to receive a notification when our latest episode has been posted, please click on the notifications bell. Lastly, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with Wayne. Thank you, and we'll see you soon.